Hi, class, and welcome to Chapter 6. We are in Week 6, Counting 201. It's been 6 weeks already. What does that mean for you? If you're missing work, you have been hearing from me time and time again, and I will continue to bother you until you submit your work. That is what I do. The reason why I do it is because it is extremely important for you to submit any work to pass this course. This is a work-intensive course. Something is due every single week, whether it's a homework assignment, a discussion board, a quiz. Um, it's very, very important that you participate and achieve all of your assignments and quizzes on time. The reason why you should be timely in this is because, first and foremost, the midterm exam is coming up in week 8. Yeah, so that's only 2 weeks away from now, and so it's very important that you have everything in before then. The reason for that is because you will see very similar questions on the midterm exam. That's a hint for you, right? The midterm exam is worth 10 points, which is 10% of your final grade. So it's very, very important that you do the best you can on that exam. The exam can only be taken once, and it encompasses, I believe it's 10 or 20 questions. I don't remember. So what that means is, I think it's 10 questions. So 1 point per question. It covers chapters 1 through 8, right? So it's very important that you do your homework and your quizzes in order to best understand what's being covered on the midterm exam. 10 questions covers chapters 1 through 8. That will be in week 8. Yep. So don't worry, we got 2 more sessions to go before that midterm exam comes up, but I just want you to be very aware that that is approaching. What else can I tell you? Those are the only housekeeping items I can think of. As always, if you have comments, questions, concerns, I have my office hours, and I have my email, and I got my phone. So you already have all of that information, so please feel free to get with me if you need help. Also, just a quick note, I did expand my office hours as well. I used to only have office hours on Mondays and Wednesdays from 11 to 3, but I've also now expanded hours to Fridays, 10 to 2. So that's just something to be aware of. And if you cannot meet with me during those hours, not a problem. Feel free to just shoot me an email, and we might be able to schedule an additional time outside of those hours. So those are the quick announcements I had. So let's go ahead and jump into Chapter 6. Okay, Chapter 6. This probably shouldn't take too terribly long, maybe about 45 minutes, possibly an hour, but I don't think we'll go the full hour. It's not as long of a presentation. Okay, Chapter 6. Chapter 6 has to do with inventory. We discussed in Chapter 5, and I believe a little bit in Chapter 4, about merchandising businesses. Merchandising businesses are businesses that carry inventory. Inventory are products that are made available for sale to consumers, like all of us. And I believe the example I gave was a water bottle for the merchandise business. I believe that was, I want to say that was last week. I could be mistaken, but I think it was.
Yeah, that was last week.
Thank you so much, Josh, for that reaffirmation, because all these weeks run together. I barely know what day it is, so I appreciate that. So we talked about merchandising businesses in the last chapter, and we're going to carry that forward with discussing how inventory is valued. We talked about how we make, I believe in the last chapter we talked about how the business makes purchases of inventory and sales of inventory and how all that is recorded through journal entries. We also talked about adjustments and things like that. In this chapter, we're going to talk more about the actual inventory itself and how it is valued. The value of inventory has an impact on the overall taxes for the business, as well as the value of the business. And we'll talk about that here shortly. Let me just close this window out. I apologize about that. Okay. I don't like when things get in the way. Okay, sorry. Okay, let's talk about how do we control inventory, and then we'll talk more about the values of inventory. There are two primary ways of controlling inventory. One is we safeguard it, and the second is we report it. Safeguard means to protect our inventory from damage or theft. How do we do that? We store our inventory in a safe location. We protect our inventory from damage by keeping it off of the floor in a well-organized way. We use an inventory system that we learned about in earlier chapters, the Perpetual or periodic inventory system, to help control our inventory. We also protect our inventory against theft by utilizing security cameras, security guards, locking mechanisms, so forth and so on. We report inventory on the financial statements. These are ways we control inventory. Okay, so as you have read about in earlier chapters, we have what we call primary documents to help with the control of our inventory. Primary documents include things like a purchase order, receiving report, also known as a packing slip, and a vendor invoice, which is the bill from the vendor. Now, as a financial controller, what I would typically do is I would take all three of these documents, scan them into my my accounting system, which is my software, my QuickBooks, and I would also attach all of those to the check and have copies of them when I write the check. And I would also have a copy of the check, attach it to those three documents, and then file it. The reason why I go through such trouble every time I pay a bill for a vendor is because it's very important that you have what we call a paper trail in the event that you get audited by the IRS or some other external party. It's very important that you have that type of control. The purchase order is what we use to send to our vendor in order to purchase our product. It's the request. I say, hey, I need 20 of these at this price. I send that purchase order off to the vendor. The vendor completes the purchase order by sending me the product with the receiving report. The receiving report is the packing slip that comes in the box. It's the record of receipt of the inventory. It's the receipt in the box, right? And these pieces of information includes the price, quantity, and description of the product that you have purchased and received. And all of this great stuff should get entered into your QuickBooks or to your Sage 50 or to whatever other accounting software you're using. Or to Excel if you so choose to use that. Most businesses got away from Excel. They're using software that is designed for accounting. Okay, let's talk a little bit more about the inventory subsidiary accounts, which we learned about in subsidiary accounts in earlier chapters as well. And we have a similar process. When we receive the inventory using Perpetual inventory system, we scan it into our system with the barcodes and all that good stuff. We enter it into the respective subsidiary inventory ledger. The subsidiary inventory ledger, as you know, is subsidiary to the inventory account, and it is typically categorized by the SKU number of each respective product that you sell. The control mechanisms we have to protect damage or theft is security cameras, have it in a restricted area like in the back storage area that's only accessible by employees. We lock high value items up in cabinets or using a security tag. I'm sure you've seen those at retailers where you have to call somebody over so they can unlock it for you for things like ink and other expensive electronic devices, so forth and so on. Some stores use two-way mirrors, cameras, security tags, guards, you name it. All methods for controlling inventory. Physical inventory. Just as you learned about with the periodic system of controlling inventory, we do physical counts. Even if you use a perpetual inventory system, you should still do physical counts of inventory. This is where you go through the store and you physically count each piece of inventory that you are selling. Even if you don't have a physical store, if you sell online, you still need to take inventory. Or let's say you have a catering business and you sell product along with the service, you probably still need to do an inventory count. This should be done at least yearly. In most cases, at least once per year near the end of the year, to ensure that what you have on your financial statements is accurate. After the physical inventory is counted, the cost of the inventory is assigned using the financial statements. Most companies assign the cost of inventory in one of three inventory cost flow assumptions. Inventory cost flow. Let's talk about these three. We have what's called FIFO, that's first in, first out. LIFO, last in, first out. Weighted average, and those are the primary three. And then there's a few smaller ones that are not so commonly used. We call them lower cost of market. We'll get into that here in a few slides. Oh, I apologize. Okay. So here are three cost assumptions. The first one is FIFO. That's first in, first out. This is where the cost flow is in the order of which the costs were incurred. So, for example, I have my water bottle. I bought a case of water on October 1st, and the case of water cost me 25 cents per bottle of water. Okay. Then I bought another case of water on October 16th. The price of water had increased over those 2 weeks to 27 cents per bottle. I will purchase another case of water on October 30th. I anticipate another cost increase. The cost flow for first in, first out is based off of the first ones that you've purchased is the cost that you record. So if I purchased water at 25 cents on October 1st and then again 27 cents on October 16th, I'm going to record the cost as 25 cents. First in, first out. That's the cost flow. We'll talk more about that here in a little bit. The second cost flow assumption is called last in, first out. And this is the reverse order of which the costs were incurred. So using my earlier example of the water bottle purchase on October 1st for 25 cents, October 16th for 27 cents, in this case, I would record the cost as being 27 cents per bottle because it's last in, first out. And then the third cost flow assumption is the average of the cost. So if on October 1st I purchased a case of water for 25 cents per bottle, October 16th I purchased a case of water at 27 cents per bottle, I take the 25 cents plus 27 cents, I divide by 2 to get the average. The average at that point, of course, as you know, is 26 cents. And so the reason for the cost flow assumption is not just for tax reasons. Of course, that's one of many. But depending on the type of cost you have assigned to your inventory will make a difference in the gross profit and will make ultimately a difference in the net income. As you recall, we get the gross profit by taking our revenue minus our cost of goods sold. The cost of goods sold is what we're talking about here. We're assigning a cost to the inventory, which ultimately becomes the cost of goods sold after we sell it, of course. So here's another example. Let's assume that we have 3 identical units of merchandise that we purchased in the month of May. I purchased in May, I purchased 1 case of water at $9. May 18th, I purchased another case of water at $13. And on May 24th, I purchased a case of water for $14. To get the average cost per unit, I add up $9 plus 13 plus 14 to get to 36. I divide by 3. The reason why I divide by 3 is because it's 3 units to get to an average cost per unit of $12. So the average cost for 1 case of water is $12. Now, let's take a look at how it varies from situation to situation. We assume that 1 unit is sold on May 30th for 20 bucks. Depending on which unit was sold, the gross profit will vary from $11 to $6 because of the difference in the type of cost that you assign to your inventory. If I sell it for $20, cost of goods sold is $9, gives me a gross profit of $11, ending inventory is $27. How 27? It's because 13 and 14 equal 27. Ending inventory 27. So remember, going back to our example, that first purchase I made on May 9th, purchased it on May 10th. I also sold it on May 10th. I sold it for 20 bucks. It cost me $9. That gives me a gross profit of 11. Remember, sales minus cost of goods sold equals gross profit. My ending inventory is 27. How did I get to 27? Well, throughout the month of May, I made 2 other purchases, one for $13 and one for $14. It gives me an ending inventory of 27. On May 18th, let's say I sold that same case on May 18th instead of on May 10th. 20 minus 13. Why 13? Because on May 18th, I purchased at $13. Gives me a gross profit of 7. 20 minus 13 is 7. Sales minus cost of goods sold equals gross profit. Leaves me with an ending inventory of 23. How 23? Well, I purchased $9 worth on May 10th and $14 on May 24th. I sold the one on May 18th. So 9 plus 14, ending balance is 23. Same concept applies for May 24th. Sold it for 20 on May 24th. I had purchased that unit for $14. Gives me a gross profit of 6. Sales minus gross profit. Sales minus cost of goods sold equals gross profit. And an inventory of $22. How 22? May 10th I purchased for 9. May 18th purchased for 13. Does it make sense so far? Yes? Hopefully.
Makes sense.
Thank you, Angela. Thank you, Joe.
Yeah.
Great. Okay. Now let's break it down a little bit further. So, under the specific identification inventory cost flow method, man, that's a long, long word, or series of words. Specific identification inventory cost flow method. It's the unit sold that's identified by the specific purchase, and the ending inventory made up the remaining units on hand. Oh my goodness, it's a mouthful. And now, basically, what this is saying is, I can, for my inventory costing method, I can select one of three options: first in, first out, last in, first out, or weighted average. And based off of that selection, my ending inventory, which is the units remaining on hand, is going to be different, because the way that the inventory flows into the business happens at different times and at different prices. So I want you to think about it from the perspective of a commodity like water or coffee or eggs, produce. These prices change pretty regularly. Every time you go to the grocery store, you notice, oh, bananas were 30 cents last week, now they're 49 cents, right? This is because of the different price points that they purchase it at. They, of course, then need to make a profit, so that's why you see the prices different on your end. We call that first in, first out, right? So because of this system, under the first in, first out, the first unit that we purchased is assumed to be sold, and the ending inventory is made up of the rest of the purchases. So again, if I purchase a bottle of water in the beginning at 25 cents, then at 27 cents, and then at, we'll say, I don't know, 20 cents, the ending inventory will be 47 cents. Or the remaining would be 47. And so forth and so on. Last in, first out, it's the opposite. So the last one that I sold is the assumed price, and the purchases I made before make up the ending balance. And then with weighted average, it doesn't matter, because I take all of my purchases and divide them by the average, or to get the average cost. Okay, so going back to our earlier example with cases of water. On May 10th, I purchased a case of water for $9. May 18th, it was $13. May 24th, it was $14. Using the first in, first out method, my sales were $20. Cost of goods sold was $9. Why $9? Because the first piece that I bought was $9. First in, first out. First in, first out. 20 minus 9 is 11. Ending inventory was whatever I purchased for that rest of that month. So it'd be 13 plus 14, 27. Last in, first out, I sold it for 14. It cost me $14. So 20 minus 14 equals 6. Ending inventory were my earlier purchases, 13 plus 9, 22. And then, of course, the weighted average, I take all three purchases, divide by 3, gets me to $12. 20 minus 12 is 8. Ending inventory is 24. How 24? Average times 2. Why times 2? There's 2 left. Does it make sense so far? I kind of like this graphic because it kind of helps to clarify,
Yes, it makes sense.
Great. Thank you, Joan. I appreciate that. Okay. Let's skip this one. I don't really like this example. Okay. First in, first out. first in, first out method is used in a perpetual inventory system. An example of a perpetual inventory system, as you know, is a way to record things that are sold frequently. That's why we call it perpetual, continuous. Think of an example of this would be like a grocery store. They probably use a perpetual inventory system. They're continually buying and selling. Every time they sell, they scan it with the barcode machine. And when they're continuously buying and selling, perpetual, continuously moving. Typically, FIFO is used in perpetual inventory system, and costs are included in the cost of goods sold and the order of which they were purchased. This often follows the same physical flow of the goods. So, for example, let's say I have a grocery store. I sell bananas and oranges and all that fun, wonderful, healthy stuff. Let's say let's take a look at our banana produce. If I sell a bunch of bananas and I continually sell those bunches of bananas, it's in the order of which I received them. Okay, I'm selling you the oldest stuff first, right? That's how grocery stores work. That's why it's first in, first out. Right? That's how grocery stores operate. They have the same physical flow of the goods. The reason why grocery stores do that is because they're perishable. They'll expire if you let the bananas sit on the shelf for too long, right? So that's why they do it that way. That's why the products that expire the earliest are the ones closest to you. That's why they say reach in the back, right? I remember going grocery store shopping with my grandmother. She would say, hey, reach in the farthest back. And now I know the reason is because it's the freshest. So true. Okay, this is a nice graphical representation of the first in, first out method. As you can see, the journal entries, accounts receivables, debit, credit to sales, cost of goods sold, debit, credit to inventory. This is because I'm purchasing inventory, and it follows the respective cost of goods sold, so forth and so on. It's just a graphical representation. There's not too much to take away from this part. But the idea is to kind of show you how the inventory is updated using a first in, first out method in a perpetual inventory system. You can see a list of purchased transactions. You also see a list of when we sold them and the changes of inventory. You'll also notice the change in cost per unit. So we had purchased it originally at $20, then $22.40, then $23.30, so forth and so on. It's like a spreadsheet kind of. So that's first in, first out. Now let's go into last in, first out. Last in, first out is when I will sell the newest item first. Newest item first. Or the last one in. I sell the last one in first. How common is this one? Not as common. It's not as common as first in, first out is, but it is useful when I am selling something that is not perishable. And it will not go bad. An example would be like headphones. I can sell headphones all day long. They're not perishable, they don't expire, and it doesn't matter when I receive them.
Would that be like a department store?
Yeah,
Like something?
well done, Joan. Yes, absolutely. An example would be Macy's. An example would be a shoe store. An example would be any other department store you can think of that doesn't sell perishable items. So an example would be Best Buy, Macy's, those types of stores. Yeah, yes, very well done, Joan. Absolutely right. A department store would use the last in, first out method. And once in a while it works the opposite way, but for the most part, last in first out it has tax advantages. Last in first out is widely used because it doesn't always represent the physical flow of units. What do I mean by that? If I receive a shipment of headphones, let's say I'm at Best Buy, I receive a shipment of headphones. I sell a few, but not all of them. I receive another shipment of headphones, the same ones. I put them on the same shelf. It doesn't matter where I put them on the shelf because they don't expire. So the ones that you're getting, the headphones you're getting, they may have just come off the truck. And the ones behind it are the ones that have been on the shelf for a month and a half. So the idea is last in first out. It does not follow it does not represent a physical flow of inventory. Now, with last in first out, you can see that the way I record the inventory cost is based off of the last one in, right? So, just think about our earlier example. I'm not a big fan of how this slide is represented. But the idea behind here is that we can see that with every purchase and every sale, it gets updated. As it gets updated, we can see the change here in our unit cost. So $20, $20, $20, $22, 40 cents, $20, 22, 40, 20, 20, 23, 30. It doesn't follow the same method that it does in first in first out. First in first out, the costs are grouped together because the first batch in is the first one to leave. With last in first out, it does not follow that same methodology. So that's last in first out. Now let's talk about the weighted average. The weighted average cost is also commonly used in the perpetual inventory system, where a weighted average unit cost for each item is computed each time a purchase is made. Okay, so for example, let's say I bought a case of water, 20 cents a bottle. Another case of water, 25 cents a bottle. Another case of water, 30 cents a bottle. Another case of water, 35 cents a bottle. Every time I make that next purchase, I update my average. So let's say I bought one for 25 cents and one for 27 cents. I average those two together, I get 26 cents. Then let's say I bought some for 20 cents plus then 25 cents and then 27 cents. So 20, 25, 27. I'm going to average, so what is that? I'm going to average about 24.5 cents. I keep updating it every time I make a purchase. So that's the idea behind the weighted average. So I went from 2 purchases to 3 purchases to 4 purchases. Every time I make a purchase, I add up each purchase and divide by that number of purchases that I've made. So in other words, it keeps updating, right? It keeps moving. That's why we call it a moving average. And you've probably heard that before math class that you may have taken. We call it a moving average because it keeps getting updated. And here's an example of that. So you can see at first we made purchases at $20, then $21.50, then $22.85. We take each time we made a purchase and divide by that number of purchases. So we can see here that I made 2 purchases. I would take all that and divide by the number of purchases to get me to my average. Okay, so that was all under the perpetual system. Now, what about the periodic system? The periodic system, as we talked about in the last chapter, the periodic system is when we record sales, it's not as common. they're kind of like one-offs, right? An example of this would be a car dealership. At a car dealership, they're not making 100 sales a day. You're lucky if they make 100 sales a month. You're lucky if they make 100 sales in 2 months, right? They use a periodic inventory system at a car dealership. The reason being is because it's not as frequent. They do physical counts of inventory, and they're less frequent purchases. That's the idea behind periodic. So what about the inventory costing for periodic? We take a physical count for the cost to figure out what the cost of goods sold is. So, but there is a similarity. So like the perpetual inventory system, the cost flow's assumption must be made when there are identical units acquired at different costs during a period. So an example here would be, I purchased, I don't want to use headphones. Let's see here. Let me think about this for periodic. I purchased, I'm trying to think of a smaller type of product that would be periodic instead of perpetual. I mean, that's why I like the idea of cars, but obviously, okay. So let's say they're model cars. Okay, let's say it's a hobby shop, right? They probably use the periodic inventory system. They have obscure things. Okay, so think of like a hobby shop that sells obscure items that you don't see that frequently, but they have some of the same, right? So like a baseball card shop or something rare like that, right? So January 1st, I have 1,000 rookie baseball cards at $20 per unit. It's $20,000. I have some more rare cards that are of the same nature, $22.40 per card, $11,200. 600 cards, not as rare, but still pretty good, in good condition, $23.30 per unit, $13,980. In the first in, first out method, using the periodic inventory system, I take my inventory, beginning inventory plus my purchases to get me my available for sale during the month. I add up the value of all of those purchases and the inventory. I do a physical count of the inventory at the end of the year. Let's say it's for the month of January. I do a physical count at the end of the month, end of January, and I see that I have 800 baseball cards on hand. Now we see that we started throughout the month, I had 2,100 cards available for sale. At the end of the month, I see that I only have 800 baseball cards left. So how do we figure out what is the value of the inventory left on hand? So using the first in, first out method, I look at the most recent costs, first in, first out. On January 30th, I made 600. I got 600 baseball cards in at $23.30 per unit, and then I look at the next most recent one on January 10th, 200 units, $22.40. At the end of the month, I'm left with that 800. Valued at $18,460. That's the first in, first out method. And think of it this way: with first in, first out, I'm just working backward. I'm working backward through it. 600. I said I was left with 800, right? My last purchase was for 600, so that means I only had 200 left out of that second purchase. You're working backward. Because first in, first out, first in, first out. So by deducting the cost from the January 1st inventory, or January 31st inventory, cost of goods sold looks like this. Beginning inventory for January 1 was $20,000. I made $25,180 worth of purchases throughout that month. Cost of goods sold was $45,180. My ending inventory balance was $18,460. So that gives me a cost of goods sold for the month of January of $26,720. How I got there? Well, my beginning inventory plus my purchases gives me cost of goods available for sale. That's the key words here. Cost of goods available for sale. In other words, that's what I have available for sale for the month. Beginning inventory plus purchases equals cost of goods available for sale minus your ending inventory equals your cost of goods sold for the month of January. Here's how the inventory flow looks. January 1, I started off with $20,000 available for sale at 1,000 units, $20, $20,000. January 10, I purchased 500 units at $22.40. That's $11,200. I sold 300 units, $6,720. I have 200 units left. And then January 30th, I purchased another 600 units, and that flows straight through to my ending inventory because remember, I was only left with 800 units on hand, 600 plus the 200 from January 10th. So this is kind of a visual representation of what that looks like. Now what about last in, first out? As you know, with last in, first out, the last ones in are the first ones to be sold. So we have 800 units on hand at the end of the month. The cost of the 800 units at the end of the month is $16,000, which consists of 800 units from the beginning inventory at a cost of $20 per unit. Again, it's kind of like working the opposite direction. So remember, earlier on, if it's last in, first out, my cost, where am I at? If it's last in, first out, I had 800 units, ending inventory, January 31st, 16,000, which consists of 800 units from the beginning inventory at the cost of $20 per unit. As you remember, $20 per unit was my beginning cost. I had 800 units left from here because remember, the last ones in were the first ones out. So 20,000 was our beginning inventory plus our purchases gives us a 40,180 minus our ending inventory of 16,000. Why 16,000? Because $20 per unit at 800 units. 16,000. Cost of goods sold available for sale, cost of goods available for sale minus ending inventory gives you your cost of goods sold. In this case, 29,180. And how does that flow look? Last in, first out. So I got these two last orders in. Those were the first ones to be sold. And then, of course, the difference, because I was left with 800 units at the end of the month. So 1,000 units minus 200, because I sold that 200 plus that second 5 plus all of that 6. 800 was left over, $20 per unit, 16,000. What about the weighted average? Again, the weighted average, it's the average of all of your available for sale divided by the number of units available for sale to get your average. Yeah? What is the average cost per unit for the ending inventory? So we had a total cost of units available for sale of 45,180. How we got there? We started with the 20,000. We made those two additional purchases to get us to the 45,180. Units available for sale for the month of January was 2,100 units. 45,180 divided by the 2,100 units gives us a weighted average cost per unit of $21.51. It's rounded because it's probably like 5.512, something like that, right? Okay. So the ending inventory for January 31st, the value of the ending inventory was $17,208. How do we get there? Remember, at the end of the month, we were left with 800 units times the cost per unit, $21.51. Okay. So going back to the example, beginning inventory, we start off with 20,000, purchases 25,180, giving us cost of goods available for sale 45,180. Minus the ending inventory using the weighted average of 17,208 equals cost of goods sold 27,972. Now, all you need to remember from first in, first out, last in, first out, and weighted average is how do I calculate the ending inventory? Okay, that's what you need to remember. All right. Now, of course, to understand which system to use, we need to compare them. And by comparing them, it tells me which one is the best given my situation. Some businesses prefer to use the last in, first out because they get the greatest tax advantage. Meaning, if I show a higher cost of goods sold, that means I have less net income, which means I have less to be taxed on, right? That's the idea behind it. Now, because there are differences between first in, first out, last in, first out, and the weighted average, these differences result in different cost of goods sold, different gross profit, different net income, different ending inventories. And we saw the difference between the ending inventories based off of those calculations that we just ran through for first in, first out, last in, first out, and weighted average. And we would assume that, of course, cost of goods sold is going to be different, which means if cost of goods sold is different, of course, gross profit and net income are going to be different. Because remember, revenue minus cost of goods sold equals gross profit minus your expenses equals net income. Since the costs, if costs remain the same, all three methods would yield the same results. But the reality is, costs almost never remain the same. So, looking at the example here side by side. Let's say we have sales of 39,000. We sold 1,300 units at $30 per unit. $30 per unit is our sales price. The difference in the cost of goods sold, gross profit, and then inventory are illustrated below. So first in, first out, weighted average, last in, first out. As you can see, the sales are always going to be the same. The difference is going to be with your cost of goods sold. If it costs, the costs are going to be different for each one, based off of your purchases, of course. So cost of goods sold across all three options, first in, first out, you'll have the lowest cost of goods sold on average, and that's typically the case. Sometimes weighted average is lower, but again, it depends on the purchases. And then last in, first out usually has the highest cost of goods sold, typically. And of course, you remember this formula: sales minus cost of goods sold equals gross profit. And your inventory balances will be different. And the reason being is because if you sold 1,300 units at $30 per unit, based off of the process that we went through earlier, you're going to have different inventory balances. What are the effects on the changing in prices? Okay. Using first in, first out, and last in, first out, we can have some comparison here. First in, first out, and last in, first out. Cost of goods sold, last in, first out results in higher amounts, or higher cost. First in, first out usually results in lower cost for cost of goods sold. Gross profit, first in, first out, usually has higher gross profit than last in, first out. Net income, first in, first out is usually higher than last in, first out, and same with ending inventory. And of course, the opposite is also true. And this is based off of the changes in prices. So if my prices are increasing, you can see what the effect is. This kind of shows you what the effect is of changing prices. You don't have to worry too much about that. It's just good to know. So for first in, first out, which reports higher gross profit and net income than last in, first out, there's one condition. In periods of rapidly rising costs, the inventory that is sold must be replaced at a higher cost. So a way to think about it. Let's say I have a super popular item. Oh, here's an example. You guys will like this. Let's say I sell toilet paper during a pandemic. Okay? It is a rapidly selling product. And since it's rapidly selling, I must rapidly replace that product. If I have a grocery store, I sell toilet paper during a pandemic. The stuff is flying off my shelves. I must quickly replace what I'm selling. How do I do that? It's going to cost me more to replenish my shelf. Okay? Because it's selling quickly. And in this case, the last in, first out method, my prices, my first in, first out is going to be more expensive than last in, first out because of those rapidly increasing costs to me. So in this case, the larger first in, first out gross profit and net income are sometimes called inventory profits, which are also known as illusory profits. I've never heard it called that, by the way. It's mostly always called inventory profits. Illusory profit, what is that? It's silly. Your book is silly sometimes. Okay. During a period of increasing costs, the last in, first out matches are most recent against the sales on the income statement. Last in, first out also offers income tax advantages during periods of increasing costs. Now, this is why I said that businesses like to use last in, first out on their reports at the end of the year because it typically puts them in a lower tax bracket when they show up with lower net income. It's one of those fancy loopholes that your friends in Congress like to talk about. Okay, under the last in, first out, the inventory on balance sheet may be quite different from its current replacement cost. Weighted average method is, in a sense, a compromise between first in, first out and last in, first out. I personally like the weighted average because it gives me a more general approach to costing inventory. I like it because as it says, it's a compromise between first and first out, last and first out, and it's also the easiest to calculate. The effect of the cost trends and average determining cost of goods sold and the ending inventory. So yeah, I personally like the average out of all three, but that's just my personal preference. Okay, what about reporting? How does it look on the financial statements? That's a very important thing to understand. So cost is a primary basis for valuing and reporting inventories on the financial statements. However, inventory may be valued at another cost in the following cases. Cost of replacement and a cost that is different than a normal prices. So for example, the cost of inventory that you see on the balance sheet may be different than the cost of goods sold. Reason being is because of the reporting difference between first in, first out, and last in, first out, and weighted average. Businesses will use one or the other for various reasons. As I said earlier, tax advantages. Some might use it for inventory because it follows closely the flow of physical inventory. But here's the thing. Businesses should stick with one or the other and not change midstream. If you go from last in, first out to first in, first out or weighted average, you have to account for the difference. And when you do that, it might end up costing you money. So that's why it's important that businesses stick with one or the other and not change. Now, there are situations where the market price might be different than the actual value of the inventory. If the market is lower than the purchase cost, we call this the lower cost of market. The market price is used in lower cost of market for net realizable value of the inventory. Net realizable value is the estimated selling price minus the cost of disposal. In this case, this happens when there's spoilage, damaged product. I can't sell it for whatever reason, so I'll dispose of it. To understand what the value is of that particular product that I'm disposing of, I take the estimated selling price minus the cost of disposal. And that happens from time to time when something's expired or damaged. So let's assume the following about a damaged item of inventory. The original cost of the inventory was $1,000. The estimated selling price is $800. The estimated selling expense is $150. The market value of this item is $650. How do we figure out the lower cost of market value? We took the estimated selling price and subtracted the selling expenses to get to $650. In this case, because I purchased the inventory at $1,000 and it's worth $650, obviously that's a loss, the inventory will be valued at $650. Obviously I could write that loss off. That's the idea. It happens from time to time. Hopefully it never happens to your business, but it does happen. Once in a while you purchase something, all of a sudden the market price goes down, and then you can't sell it for what you bought it for. That's basically what that situation is. Lower cost of market can be applied in one of three ways. The cost of the market price and any declines are determined by the ending each item in the inventory, each major class of category for the inventory, and the total inventory as a whole. This is an example of this. The lower cost of market. So in this example, we have 5 different items with different quantities at different prices at different market values. We can see from this example that I have 2 products, the Echo and the Sierra, that are below market value, below what I purchased them at. So cost, market, lower cost of market. Lower cost of market tells me the which one is lower, my actual cost or the marketplace? In this case, when the market is the lower cost of market, I have a net realizable loss. What is the impact on the balance sheet? So as you know, inventory is reported on the balance sheet as a current asset. Inventory is reported as a current asset on the balance sheet, and therefore the costs are associated with that inventory on the balance sheet. Method is used by the selection of either first in, first out, last in, first out, or the weighted average. The method for valuing the inventory is also known as the cost of the lower cost of market. Here's an example of what that looks like on your balance sheet. So we see current assets, cash, cash equivalents, any investments the company has, accounts receivables, allowance for doubtful accounts, and then of course we have our inventory. In this case, in this business, the business is using the lower cost of market, which is first in, first out, or also known as the net realizable value. And so the company's inventory is valued at $120,000. And so just kind of like an example of what it looks like on a balance sheet. Sometimes there's errors in reporting on the financial statements, as you know. And when that happens, we need to make adjustments. There are a couple of reasons why there might be errors on the balance sheet. Sometimes we miscount things. We missed a physical count. The cost may have been recorded incorrectly. There was a situation in transit that was excluded from inventory. In other words, I did my inventory count and then a truck showed up with more, right? It happened. So that truck was excluded from the inventory. Consigned inventory is not counted in most cases. Consigned inventory, you might be wondering. Consigned inventory, if you've ever been to what we call a consignment shop, a consignment store, the store does not pay for that inventory until the inventory is sold, and the store will then pay that part of the proceeds to the original owner of that inventory. Another example is eBay. An example would be eBay. More errors. Inventory errors often come from merchandise that is in transit at the end of the year. So let's say I purchased some more inventory on December 20th, and it doesn't arrive until January 1st. Well, I can't count it for that year because I didn't get it during that year. Shipping terms, as you know, express of who owns the merchandise and when. And remember this from the last chapter, free onboard shipping and free onboard destination. With consignment. So consignment's interesting. Inventory errors arise from consignment inventory. This is where manufacturers will sometimes ship merchandise to retailers without charging them for the inventory until it is sold. The manufacturer in this situation is called the consignor or consigner. They own the merchandise until the point that it is sold. The store that is receiving the merchandise to be sold without actually owning the merchandise is called the consignee. And any inventory at the end of the year typically either goes back to the manufacturer or eventually it'll change hands from the manufacturer to the retailer. Effects on the income statement based off of errors. Inventory could be understated or overstated based off of these circumstances. And of course, it'll have an effect on the beginning balance and the ending balance. And this is an example of what that looks like. Okay. I'm getting toward the end, so there's only a few slides left. Yay! Okay. Ratios. Yeah, I know you guys love ratios. All right. As managers, we need to make decisions based off of inventory. We need to understand how effective our business is at selling inventory. And a way to do that is to make a few calculations. One of them is called inventory turnover. This measures the relationship between cost of goods sold and the amount of inventory carried during the period. In other words, how quickly am I selling it, right? It measures the number of times inventory is turned over or turned into sold goods during the year. That's what I call it, inventory turnover. How quickly are we selling it? We take the cost of goods sold divided by average inventory. Average inventory is calculated by taking your purchases throughout the year and dividing by the number of purchases. In this example, it's 2. So let's say Best Buy has an average inventory of 5.275 million. How do we get that? We had 2 major purchases and we divide it by 2 times to get the average inventory. To figure out the inventory turnover, we take the cost of goods sold, okay, plus, and to figure out the average inventory, we take the beginning of the year inventory plus the end of the year inventory and divide by 2 to get the average. Cost of goods sold divided by the average gets you an inventory turnover ratio, in this case 5.9. 5, which is a good number. Typically in this situation, the higher the inventory ratio, the better. Now, what about the days of sales? Days of sales inventory tells me how long it takes me to sell it, right? On average, how long it takes me to sell it. And to figure this out, we take the average inventory and divide that by the average daily cost of goods sold. To figure out your average daily cost of goods sold, you take your cost of goods sold and divide by 365 days to get your average daily cost of goods sold. And of course, your average inventory, you take your beginning inventory at the beginning of the year plus your ending inventory end of the year, divide by 2. So average daily cost of goods sold divided by average inventory gets us to our number of days of sales and an inventory of 61.6 days. It's better than it was in year 1. The lower the number, the lower the number of days in inventory, the better. Because that tells me how quickly I'm selling it, right? And that, my friends, is the end of chapter 6. Inventory. Yay, inventory. Okay. Are there any comments, questions, concerns that I can help you with chapter 6 or anything else in the class for that matter?
I think we're good.
I'm good, Josh?
Well, I'm good. Yeah.
Well,
Well,
that's good.
I do have a discussion that I put in. I know it was late, but I put it in a couple days ago. So I just want to make sure you can take a look at that.
Yeah, absolutely. Will do.
Yep, that's it. Thank you very much.
Thank you. Appreciate it.
Professor, I had a question about the QuickBooks certification.
Yes, Joe.
I see that comes up a lot, but I don't know exactly what that is.
Yep. So I'm going to make an announcement on that after the midterm. The reason why I do it after the midterm is because I obviously don't want you to be distracted by that. It's an extra credit opportunity. The QuickBooks is a certification that you can earn at no cost, so meaning free. Through QuickBooks, it is basically a way for you to be certified to use QuickBooks. In other words, if you put something like that on your resume, it makes you look as if you know how to use an accounting system like QuickBooks. QuickBooks is a accounting information system. It's similar to Sage 50 or there's a lot of other larger ones out there. It's basically a certification opportunity that I'm offering to my students as an extra credit opportunity for this course. And essentially, if you become certified as a QuickBooks user, then you'll be able to earn extra credit points. And but I'll make an official announcement about that after the midterm exam. So in about 2 weeks, I'll make an announcement about that.
Quick
Sounds
question.
good.
I
Thanks.
have
Awesome. You're welcome. Go ahead, Josh.
I have my QuickBooks certification through my place of employment. Would that be sufficient, or would I have to take it again?
Email it to me, and
Okay.
I'll take a look and I'll let you know.
All right. All right.
Because
Perfect.
there
Thank
are
you.
different ones out there. That's why I'm.
Okay. No, that's perfect. If not, I can take it again. It's fine. I mean, I use it
Well,
every day.
or I'll ask you to take the higher of, which one ever is
Hey, if it's double points, I'll do it.
better. Cool. Thanks, Josh.
All right. Thank you.
Yeah, that's funny. Good question. Okay, are there any other comments, questions, or concerns I can help to answer at this time? No, everyone's good. All right. Well, if there are no other comments, questions, or concerns, I'd love to call it a night. If you think of anything, just go ahead and send me an email. Or you can call me or schedule office hours with me. I am here to help in any sense of the way. And I hope these sessions are helpful for all of you. As you know, they are optional, but I really do hope that they help. And I think that our discussions are good. I think the examples that we go through are important. And overall, my goal here is just to help you to better understand the concept of accounting and how it can help you as a manager to improve with your businesses and with everything that you do. So, but I appreciate it.
Thank you, Professor.
Thank you, Angela. And with that, I hope you all have a wonderful evening.
Thank you.
Thank
Good
you.
evening.
Good evening, everyone.
Thank you all so much. Take care. I'm looking forward to next week.
You
Take
too.
care now. All
Thank you.
right, have a good night. Good night. Good night. Good night. Good night.